Good morning, good afternoon, good day to everyone. Hello and welcome to today's webinar. I'm Chris Roberts. I'm the executive editor of MJBizDaily, and I'm thrilled to be your moderator and also a proud member of the audience for today's session, in which we're going to explore challenging 280E, marijuana rescheduling, tax refunds, and the risk of waiting from our friends at Calyx CPA. But just before we jump in, some programming notes. For anyone watching right now who might be new to MJBiz, we want to welcome you. We encourage you to join our community, follow us on social media, LinkedIn, of course, and check out MJBizDaily.com as well as MJBizConference.com for our great content offerings, which includes everything from breaking news, timely trend pieces, and success stories from around the industry, as well as research reports and more webinars like this, where you can learn actionable B2B intelligence to help your business. To make things a bit easier, you can subscribe to our newsletter to get the latest news and content delivered right to your email inbox several times a week. And of course, registration is open for this year's MJBizCon, December 1st to 4th in Las Vegas, Nevada. We'll put a registration link in the in the chat, and there, of course, you're going to hear from such industry operators as the experts who are with us today. But before we do that, let's take a real quick look at our platform today. The On24 console that you're looking at right now can be completely customized. You can go crazy. You can move stuff around. You can resize windows, making the video or the slides larger or smaller as you like. You're also going to find an array of interactive tools in this experience. In that toolbar, you'll see a media player. It's for your video and for your volume. Q&A box, that's important. This is where you can submit your questions in the widget on the top right of your screen in real time, and we will get to as many of those questions as we can at the end of the presentation. You also see a resource list. You can click through to download the slides and related resources provided to us by our friends at Calyx CPA. And of course, perhaps last but not least, maybe most important, is the survey icon in which you can click to share your feedback at any point during the session. Your input's really important to us, so before you log off today, please be sure to take a moment to share your feedback to help us plan and improve future events. And if you have any follow-up questions, or if you need help with your experience, just send a question in the Q&A box or press the help icon to get further guidance, and one of us will do what we can to help you out. Before we kick off today's conversation, I just wanted to take a couple minutes and introduce both our subject matter expert broadly and individually. So Calyx CPA is a cannabis-focused accounting and tax firm. They're from Medford, Oregon. They focus, as I just said, specifically on cannabis and psychedelics. And the firm is known for challenging the IRS on cannabis tax burdens, such as Internal Revenue Code Section 280E, as well as navigating the complex web of state and local tax regulations that anyone in this sector knows all too much about. Individually, let me introduce you to our two speakers. Botillier is the CEO of Calyx CPA LLC. With more than 20 years of experience advising business owners, he has built a national practice focused on cannabis accounting, cannabis tax strategy, and Internal Revenue Code 280E. Before recreational legalization, Justin was among the first accounting professionals to publicly advocate for cannabis operators. And in 2016, he sold his general practice to focus exclusively on our industry. Today, Justin helps operators around the country challenge the impact of Internal Revenue Code 280E through aggressive but defensible tax strategies. Having worked with thousands of business owners and cannabis companies, he is uniquely qualified to provide high-level business advisory services to cannabis operators seeking to optimize entity structure, support their business growth in an emerging market, and navigate the complexities of operating in a highly regulated industry. And joining Justin is Jamie Jorgenstone. Jamie is also a CPA and tax strategist, and she is the Chief Technical Officer at Calyx CPA LLC, where she advises cannabis and emerging plant medicine businesses on complex tax issues. As one of the founding partners of Calyx CPA, Jamie has helped build a national practice focused on cannabis accounting, tax strategy, and the same aggressive but defensible tax positions. Her work focuses on deep technical tax analysis, identifying opportunities in underutilized areas of the tax code, and navigating these complex business structures to help mitigate tax exposure in highly scrutinized industries. Jamie's known for bringing both technical rigor and practical insight to challenging tax questions. She frequently speaks on legal developments affecting cannabis businesses, including evolving IRS authority and strategies operators can use to mitigate the impact of 280E while preserving a defensible tax position. We're especially thrilled to have them just days after the marijuana rescheduling hearings at DEA wrapped up, so we're in fantastic hands. With that, I want to pass it off to Justin.
All right, thank you, Chris. That was an incredible introduction, much appreciated. So the purpose of this presentation today is to update you regarding the various legal developments that impact the applicability of 280E and how you can take advantage of them to avoid suffering further damages caused by 280E, or better yet, correcting at least some of those damages caused by ahead of rescheduling or waiting for further guidance by the IRS, which could come at any time. Many of you have attended presentations we have done in the past, but some of you may be new to 280E, and I often get a little bit of pushback by people who aren't familiar with 280E as much as those of you that are, which should be the vast majority of you by this time. But this presentation is divided into two parts. The first is going to be a brief introduction to what 280E is and how it has impacted the cannabis industry, and also a little bit of the history of how in the past we have challenged 280E to mitigate its damages, which in turn will inform how our current strategies, what we're doing with our current strategies. The primary purpose of talking about the history is not only to give you an idea of what we as accountants in the cannabis industry have gone through historically to challenge 280E, but also to hopefully demonstrate that the methodologies and positions we're using today are not frivolous. These are supported by the statutory language of the tax code itself, as well as their interpretations by our cohort of other cannabis and legal professionals that we work with, and should be taken very seriously. Oftentimes we get a lot of criticism by other legal and accounting professionals, criticizing our position, telling us that we're putting our clients at risk, but always fail to provide any solution for any pathway to mitigate the impact of 280E themselves, and instead just allow you to continue to be victims of this unjust and outdated tax code. So the second part of this presentation is going to be presented by Jamie, who is going to discuss what is happening now, including the recent developments regarding the New Mexico tax organics case and the current DEA rescheduling efforts. Then in conclusion, it's our belief that you are not required to proactively pay tax on phantom income, and that you have a reasonable basis to amend your tax returns for refunds now, instead of waiting for rescheduling to conclude and waiting for guidance by the IRS, which can, we don't know exactly when that's going to come. So that'll be the last part of the presentation. All right. So this slide deck is a little bit more robust than what we're going to cover today. You should have access to the PDF from MJBiz so that you can peruse that at your own time. This is probably a 3-hour presentation that we're cramming into 1 hour. So there's a lot of information included in the slide deck that we won't cover. Also, I'm not sure how much Q&A we'll have time for, but we intend to do a follow-up Q&A, which we'll email you an invite to attend that. It's probably going to be next week or something like that, sometime soon, to be able to address your questions. So section 280E, I'm going to try to be very quick here. It's a tax penalty enacted by Congress to ensure that drug dealers pay tax on their gross profits rather than on their net income like legal businesses. in 1982, a cocaine dealer named Jeffrey Edmondson won a tax court case that allowed him to deduct his ordinary and necessary business expenses and pay taxes like any other business would. And Congress didn't like that. So they responded by passing Section 280E, which disallowed businesses trafficking in substances that fit the meaning of a Schedule 1 or 2 substance of the Controlled Substances Act from deducting their overhead expenses. Unfortunately, even though the intent was to target dangerous dealers, drug dealers, the code section continued to apply to marijuana businesses, even though we now have over 40 states with their own marijuana regulation. Due to 280E, cannabis businesses have probably overpaid billions of dollars in taxes that would have not otherwise applied had 280E not existed. And if you apply 280E at face value, meaning you do nothing to attempt to mitigate it, then you will likely be buried in an unsustainable amount of tax debt. And I've personally seen this happen to probably hundreds of businesses at this time. I like to use a figure, at least what you can expect if you don't apply any methodology to mitigate the impact is an 80 to 90% effective tax rate, meaning if you have a positive cash flow of $100, you're going to pay like 80 to 90%. More specifically towards retailers, because retailers have a lot less what they call cost of goods sold. And that's the one thing that 280E will allow you to do is deduct your cost of goods sold. And that's going to be a big, big part of this conversation going forward. But then there's also businesses that don't have any positive cash flow. They'll just be investing money and they might have some revenue and they'll pay tax on that gross revenue whether or not they had any positive cash flow. So sometimes they can be out hundreds of thousands of dollars and then get a $100,000 tax bill on top of that. So it's impossible. Let's see here. So back when I was first starting working with dispensaries back in about 2014, when I applied 280E, and I recognized the impact it was going to have, I told them to just don't even file their returns. It's better for you not to file your returns and then fight them later, the IRS later, than to proactively pay or proactively file a tax return that's going to bury you in tax debt and create a decade of burden. So one of the code sections that we landed on was 263A, which is an inventory methodology. It regulates how we calculate inventory, and it's typically for manufacturing businesses only, where we're allowed to take some of our overhead costs and apply it to our inventory. And then once we sell our inventory, we can write that off as cost of goods sold, which is allowed by 280E. Unfortunately, that was a failed attempt. Harvard side tried to use that, and the judges came back and pointed out part of the language of 263A, pretty much saying that, hey, it says in the code that if a deduction is otherwise disallowed by another code, section 280E, then for example, 280E, then you're not allowed to use 263A. So we couldn't use 263A, but the important part is the language that they pointed out. The tax court pointed that out, and it comes in the future. So then we landed on another code section called 471A, and 471A was similar to 63 in that we were allowed to move some of our overhead over to 470 or into inventory, and then later deduct that as cost of goods sold. So at that time we were doing these complex, like we were segregating payroll, so the employee's time spent bagging and tagging and doing like inventory management stuff was deductible, and then the times that they were on the sale floor was not deductible. And then we would do like an overhead schematic. So we would write a floor plan and be like, well, this inventory, this proportion of the square footage of the dispensary, we're going to apply that prorated amount towards the overhead and take that as a deduction, but we're not going to take the sales floor square footage as a deduction. So it was really complicated and frankly a little flimsy at that time, because how could a dispensary actually justify being considered a manufacturing company unless you're vertically integrated, which I would say a lot of places were vertically integrated, but a lot of places weren't. But it was something. The important part, though, the message of this, though, is that the IRS actually condoned the use of 471A. They allowed it to go through when we were using these methodologies to bring our clients' tax rates down a little bit to like a little bit more sustainable levels. The IRS allowed it, even though it wasn't completely cut and dry. So that's kind of the important message of that. So then fast forward to 2018, the Tax Cuts and Jobs Act passed. We got what's called 471C, which superseded 471A, meaning 471A went away and was replaced by 471C. That's important, that 471A went away, and now we have 471C. And it was a big win for the cannabis industry. And the reason why is because it greatly simplified the inventory methodology that we were allowed to use. We no longer had to do this schematic over, like creating floor plans or segregating payroll. We could simply move our overhead into inventory based on our own methodology, because that's what it actually says in the tax code itself, is that we could use any methodology to calculate our inventory as long as it's based on our books and records. And this also applied to all businesses, not just manufacturing companies. It allowed all businesses, including retailers, to calculate their inventory any way they see fit, as long as it matches our books and records. That was essentially what the law required. So there was a lot of us that were putting, not us necessarily, we weren't as aggressive as some people, but you can put 100% of your overhead into inventory if you wanted to. And therefore, it absolutely destroyed 280E at that time. And we had 2 years of really good years in which we were bringing our clients' tax debt down to very near legal levels. And then the IRS got some pressure by their governing body, TIGTA, Treasury Inspector General for Tax Administration. That's what it's called. And we just call it TIGTA. And anyway, they got some pressure. They pressured the IRS to close the loophole. And so then what the IRS did was create some regulation that's set. And this is the important thing. The reason why I brought up 263A is because the IRS essentially almost copied and pasted language from 263A and put it into the regulation to deter the cannabis industry from using 471C like we did with 263A, essentially saying that the regulation essentially said that if a deduction is otherwise disallowed by another code section, i.e. 280E, then you can't use 471. Now, if this was the case at that time, if we took this seriously, if we were like, oh, okay, then 471 was no longer available to us, period. And we were back to that incredibly damaging, unsustainable amount of taxes, okay? And so other tax attorney colleagues and accountants of ours, we all put our heads together and we're like, what are we gonna do about this? Well, first of all, the IRS doesn't write the tax code. The tax code is the highest level of authority, right? Congress writes the tax code. The IRS does two things. They enforce the tax code, and they will provide guidance if there's ambiguity in the tax code. Well, the IRS, there was no ambiguity in the way Congress had written 471C. So simply the IRS is putting a wet blanket on the cannabis industry, and it did a really good job. Because now when we go file a return, we have to put in disclosures. We're saying, hey, we recognize that you put in this regulation, but we disagree, and we're going to move forward with the way we were doing it. And that's exactly what we did. And now to this day, 471C has not been challenged in tax court. And so our methodology of applying 471C has been successful, and we have mitigated millions and millions of dollars of taxes on behalf of our clients over all of these years. So we continue to use that. All right. So turning over, I'm going to try to be very quick in regard to some of these other things, but one of the things that also reinforced the cannabis industry's boldness to continue to use 471C, even in light of the regulation that we essentially are ignoring is that the Supreme Court overturned what's called the Chevron deference. And that's going to be something you're going to hear a little bit about probably in Jamie's presentation, perhaps, as well, where it used to be that the courts would give a lot of what's called deference to the court system to the federal agency. So the court system would defer to the federal agency. So the court system would defer to the IRS and give them a lot of what's called deference. So if the IRS says something, then the judges are like, okay, we're going to take that serious. And you know what? I don't see any incredible holes in what the federal agencies are putting out there as far as regulation. So we're going to defer to the federal government. And now when they overturn the Chevron deference, they flipped it. Now the judges actually are the ones who have to decide. They're not necessarily so easily giving deference to the federal agencies now. And that was a big deal. And I actually noticed that there was a big uptick in the accountants that started to use 471C after the overturning of the Chevron deference. Okay, and then back in 2023, crazy, all of a sudden we get word, in the news that TrueLeaf got $113 million in refunds, which blew my mind for amended returns. So I'm sorry, they amended their returns 2019, 2020, and 2021, and they received $113 million in refunds for amending their returns. People forget that this happened, but it happened. And that is what kind of like popped the lid off of the cannabis industry from, getting screwed over by the government on this. All of a sudden, we've got this big company, high-profile company, amending their returns and getting $100 million. Why can't we get that? Why can't our clients get that? Why can't you get that? So we were, unfortunately, TrueLeaf was kind of was a Scrooge in regard to their information and how they amended the return. So we did our best to figure out, like, okay, what justification, what reasonable basis are they using to amend their return? Well, we landed on what was called the Canada Provisions case. It was a Supreme Court case where it was a case challenging some tax or some Supreme Court precedents called Gonzalez versus Reich, where we believe that the federal government enforcing the Controlled Substances Act on state regulated programs was actually unconstitutional and violating what's called the Commerce Clause. And that's because we are, in the cannabis industry in states with programs, we're siloed. We can't move product across state lines. So therefore, really the federal government only has the authority to govern or to enforce their rules on interstate commerce, right? So we're not allowed to move product over across state lines. So therefore, it's a states' rights thing. And so we started to amend tax returns based on this. And that continued to go up the ranks. It kept getting turned down because the Supreme Court had already, through Gonzalez versus Reich, taken a federalist perspective back in 2015, I think it was, or maybe 2012. I can't remember it off the top of my head. But that was a much more federalist Supreme Court that was there at that time. And now the Supreme Court has changed. They have overruled Roe versus Wade, for example, right? It's very conservative. So if this case goes to the Supreme Court again, it is likely that if forced to hear it, they would probably rule in favor of the plaintiff. But it got all the way up to the Supreme Court, and the Supreme Court doesn't want to look at it. So that's fine, though, because we have other ways of challenging 280E, mainly because in 2023, the HHS and the FDA recommended that the DEA reschedule cannabis because they no longer, because they said in their letter that it solidly meets the criteria of a Schedule III substance and not a Schedule I. And that's the first time we have actually had the federal government overtly say that, hey, cannabis is not scheduled properly. It's not a Schedule I substance. I mean, we've known this for 50 years. It's been being challenged for 50 years. And even Congress had committees that were like, hey, cannabis doesn't meet the criteria of a Schedule I substance. And that's one thing I didn't go over at the very beginning of the presentation, but what a Schedule I substance is it has no medical benefit, it's highly addictive, and it's dangerous. Well, we know that cannabis is none of those three things, but the main thing that we've been focusing on is the fact that it also has medical benefit, and therefore can't be a Schedule I. It really is miscategorized, and so that has created a whole new chapter in our ability to mitigate 280E or challenge 280E, and primarily because of what the statutory language of 280E says. So one thing that people think that, and the IRS's perspective, is that that 280E applies to businesses that are trafficking in substances that are classified as a Schedule I or Schedule II substance. So that's the IRS's interpretation of 280E. But if you read it closely, it doesn't actually say that. It says that 280E applies to businesses that are trafficking in substances that fit the meaning of a Schedule I and II substance of the Controlled Substances Act. And so what do they mean by within the meaning of? And Jamie's going to talk a little bit further about the New Mexico Top Organics case, but before I turn it over to her, we have been successfully amending returns and moving forward with our clients not paying tax on phantom income, because we're using the reasonable basis that the statutory language of 280E, what it actually says within the meaning, because the HHS wrote this letter, the DEA now has rescheduled medical marijuana to Schedule III. These agencies are now admitting that cannabis does have a medical benefit and therefore actually doesn't meet the criteria of a Schedule I substance. It meets the criteria of a Schedule III substance, and therefore 280E doesn't apply. And so until all of this, shakes out, all these other developments shake out that Jamie's going to talk about, we have a reasonable basis to move forward to not pay tax on phantom income, as well as potentially amending your returns to get refunds, similar to TrueLeave and many other companies are amending returns. So let's see here. I think that just given time, I am going to turn this over to you, Jamie, just because, again, this is a 3-hour presentation that we're cramming into 1 hour. And I think a lot of people are probably more interested in the rescheduling now than hearing me prattle on about what's been going on. So I appreciate your patience.
Sounds good. All right. Well, thank you, Justin, for that SparkNotes comprehensive history of where we've been. Now that we're kind of up to speed and you've sort of set the scene, we're going to talk about, where we are now. It's been a very, very active few months for the cannabis industry, kind of all kicked off by, in last December, President Trump issued an executive order. Sorry, I'm probably in charge of these slides. Give me a second. I guess I'm not ready to move the slides. So President Trump issued an executive order, calling for the expeditious completion of the rescheduling of marijuana from Schedule I to III. And then after that, we've seen kind of a series of events unfold. So I'm going to touch on, in April, we saw the final order, which immediately rescheduled, certain marijuana products from I to III. And then at the same time, it kicked off, or kind of revitalize the more administrative process of the broader rescheduling of marijuana as a whole, initiated by the Biden administration. That's been stalled for quite some time. And then, of course, we've seen some developments on the New Mexico top organics court case, which is, as you mentioned, challenging the IRS's interpretation of 280E. So I'm going to touch on all of that. Pretty high level, I want to touch on all of that. As Justin mentioned, we are kind of tight on time. And I want to shift the discussion after I bring everyone up to speed onto, what it means for taxpayers right now, because there's still a lot of, we're still a long way from final resolutions, really, of a lot of these topics. And so despite the uncertainty right now, what can a taxpayer do and what options are available? And so I'm going to go into a little more depth on what it means to have a reasonable basis to take an uncertain tax position, statutes of limitations for taxpayers, and then kind of the practical risks and rewards of taking these positions. So I want to leave everyone, my goal is to kind of leave everyone informed enough to make a decision about what's right for you as a taxpayer, in your unique circumstances. So I think we can dive in, starting with the rescheduling. So in April, a final rule was issued, which immediately rescheduled FDA-approved marijuana products and medical marijuana products from Schedule 1 to Schedule 3. So normally rescheduling happens through this administrative process where there's like a proposed change of a rule, followed by administrative hearings, followed by an administrative law judge making a recommendation, and then the DEA issuing a rule. Okay, that's kind of what normally happens, and that's the process we saw initiated under the Biden administration a couple years ago, and then since stalled for kind of indefinitely. It's been stalled. So this is like an alternative. What happened here was an alternative route to rescheduling, where the Attorney General has this authority to immediately, schedule a drug or reschedule a drug. And so that authority was, invoked, and immediately medical marijuana and FDA-approved marijuana products were rescheduled from 1 to 3. So that happened, and then kind of simultaneously but separately, the DEA announced that they were going to get that administrative process for broader rescheduling kind of going again. So as I mentioned, it had been stalled. They scheduled new administrative hearings to start in June, and those actually concluded last week. And now that process is continuing to move forward. But separately, medical marijuana as it stands today is in Schedule 3. And what that means is 280E definitively does not apply to those, to operators trafficking in those qualifying products. So with recreational marijuana, adult use marijuana, we have it's still in Schedule 1 as of today. So it's kind of like an unprecedented, thing to happen where a substance is bifurcated across 2 schedules. We've never seen that before. So that is, of course, causing controversy and confusion. And so what the order did not do, as I just mentioned, was reschedule adult use cannabis. That is separate, and we're waiting for kind of that to unfold. Businesses that are dual licensed, are kind of awaiting guidance on how they're gonna allocate their expenses. Interstate commerce is something people are talking a lot about. So while interstate commerce didn't just magically become available, the DEA registration process that was created with this rescheduling order is potentially kind of laying, is kind of the first step towards possible interstate commerce in the future. And this is really important. The order did talk about potentially considering retrospective relief with regard to 280E for operators who had a qualifying state license back to the date they received their license, which is really cool to have that in the order. But to be very clear, that is not the Treasury or IRS saying that. That is the Attorney General encouraging the Treasury to consider that. So we are still awaiting further guidance on what what the Treasury's decision is going to be with regard to kind of an official green light for amending tax returns. Let's see, did I have anything else to say about that? Let's talk about the hearings a little bit more. So the adult use cannabis, as I mentioned, those hearings took place, administrative hearings took place starting at the end of June and through the end of the middle of last week. And now we're just kind of waiting, unfortunately. So we're waiting to, the next step is an administrative law judge kind of reviews everything and makes a recommendation. And then the DEA is the one who ultimately makes a final order on what's going to happen to, marijuana as a whole. There's no timeline on that, unfortunately. There's no requirement for that to be completed in any sort of time frame. Historically, we've seen it take potentially up to a decade. So that would be horrible. Hopefully that's not the case, but we really don't know how quickly or slowly it's going to move. Thus far, we've seen a lot of pretty quick movement since that executive order. So it's possible it will move quickly, but again, just speculation. Yeah, so I guess we'll move on. So now the order, oh, Justin, I can't hear you.
I'm sorry, Jamie, are you able to move the slides?
Yeah, I can move them.
Sorry, I thought I misheard and you had to move
okay. Thank you. Yeah, so let's move on to these legal challenges. So when this final order was issued, as I mentioned, it was very controversial, and many professionals in the industry kind of anticipated legal challenges to the order, which have since come to fruition. So over the last few months, there were several challenges brought against the order. And since then, 3 of them have been consolidated, and kind of the petitioners are collectively asking the court to, kind of scrap the order. They think it was unlawful. I'm not going to get too much into those arguments because, I'm here for the taxes. So we won't get too much into it, but it's important to know that's happening. And it's also important to know that a couple of the petitioners have requested what's called a stay, while the court case unfolds. And what a stay would do if it were granted would delay the order being effective, taking effect, which would be pretty disruptive, considering a lot of people have, since April been moving forward under the assumption that 280E definitively does not apply to their operations if they're a qualifying, operator. And we've even seen some MSOs uplist to the stock exchange, which wouldn't be a possibility if this order is ultimately not effective. But as of today, it remains in effect. So as of today, we look at marijuana as a bifurcated substance, of which some of it is subject to 280E, arguably, and some of it is definitively not subject to 280E, and we kind of await further guidance. The Treasury and IRS did come out with really preliminary guidance pretty quickly after this order was issued, which essentially just said, hey, stand by for more comprehensive guidance. But I do want to bring up one point that I think is really important, which is that they did mention or tell taxpayers to anticipate that the relief from 280E would be, it would extend to the beginning of the tax year. And so the order was obviously mid-tax year in April, and they said, okay, so 280E probably won't, assuming you qualify, it won't apply starting January 1st of the year if you're a calendar year taxpayer. What that kind of signals is that there is some kind of retroactive ability here. So the IRS's position has been thus far, until it's rescheduled officially, until marijuana is Schedule 3 or is not 1 or 2, then 280E applies. And now they're kind of signaling, okay, well, even though it wasn't rescheduled till April, you have the full tax year, which I think just kind of reinforces the argument for retroactive treatment a little more. they're sort of opening the door that if we can go back a few months, then why can't we go back further than that? Because in January, medical marijuana was Schedule 1, so how could, 280E should have applied? So I just want to bring that up. Again, we await further guidance, as always.
Hey, Jamie, Chris posted, I remember seeing this article this morning that, I don't know if it was last Friday or just today, where the administrative law judge of the DEA that's doing the hearing said that he wants briefs filed by August 17th, meaning, so that's where like they can actually file. I don't know exactly what that means, but people can write additional arguments, I guess you could say, or you may or may not talk about the brief for New Mexico Top Organics, the amicus curiae.
Yeah, I'm going to get to that.
The same thing. Yeah, go for it.
So that's really interesting. So August 17th is another date to keep in everybody's minds as all of this unravels. And so it does maybe indicate that things will continue to move somewhat quickly, expeditiously, so to speak, with this process. So okay, so that's kind of the rescheduling order and kind of the broader rescheduling efforts. Let's move on to New Mexico Top Organics. Okay, so this New Mexico Top Organics is the tax court case that Justin spoke to earlier a little bit. Essentially, the court argument is that 280E does not apply to state licensed cannabis businesses because cannabis does not, fit the meaning. It's not within the meaning of Schedule 1 or 2. When you actually look to the CSA's criteria for categorizing substances across Schedules 1, 2, and 3. And so that is the argument being, presented right now in tax court. A taxpayer disagrees with the IRS, and so they're kind of duking it out in court, right? And so the Ultra Health petitioned, so New Mexico Top Organics doing business as Ultra Health, so we'll refer to them as either one, not to confuse people. Ultra Health petitioned the tax court in December of 2024. Briefs started in October of 2025, and they've been going back and forth with briefs ever since. So New Mexico, Top Organics, Ultra Health went, and then the IRS replied, and then Ultra Health filed what was like intended to be their final reply in May of this year. But of course, the April rescheduling kind of disrupted that. And so in the May brief that Ultra Health filed, they spoke a lot to the rescheduling order. And so then the IRS was like, well, hey, we didn't get to talk about that. So we wanna say some more stuff. The court allowed it. And so now there's supplemental briefing that's scheduled. So in July, the IRS has to reply. In August, Ultra Health gets to reply back. And then in September, the IRS replies again. And then we wait for more guidance or for more progress on this case. I know Ultra Health would like to do oral arguments, but the court has to grant their request, basically. So more progress again. And also, it's looking like it's going to be quite some time until we have any sort of decision here. But the New Mexico Top Organics case is really interesting in that we get to see, if you read the briefs, pretty in-depth, the IRS's position on this. But it really highlights that the IRS does not just get to determine what's right here, right? So the taxpayer can challenge the IRS. That is allowed in taxes. You can do that as a taxpayer. You can't do it frivolously, and you can't do it just, if you're uninformed. But if you have a real argument, you are, allowed to challenge the IRS, and then that's where the tax court comes in and kind of determines who's right or wrong. Okay, so that's that. Let's see if we can keep moving here. Okay, so statutes of limitation. So we're going to kind of move on now. Those are kind of the updates, high level, as I said. I would like to talk more about all of them. I could talk about them for hours, but unfortunately we're short on time. So come back to the Q&A we do in a week or two and ask all the in-depth questions. So the statutes are expiring. So taxpayers are subject to statutes of limitations, right? So you usually have, in general, you file an original tax return, and then you have 3 years from the date you file that return to file an amended return in order to claim a refund of taxes that maybe you overpaid. So those expire. 3 years is 3 years, and you generally can't extend that. I'm going to talk about generals here because I again don't have time for all the nuances. There are nuances with statutes of limitations, but we'll talk about the general ones here. So you have 3 years. So as we wait for guidance, each day for some taxpayers, statutes are closing. And once those are closed, it doesn't matter what ultimately is decided, you know, in a year or in 2 years. If the Treasury decides, you know what, we should grant retroactive relief for 280E for all the years since there was like a state license, you know, if that were to happen, if your statutes of limitations have expired, you're out of luck either way, even though the government says they were wrong and you deserve that money back, you just can't get it back if the statutes have expired. So that's why this is a really important and pertinent conversation for taxpayers now, even amongst the uncertainty. You have to understand the uncertainty and then figure out, you know, if you want to act or not act, because you are going to be forfeiting your right to those funds completely unless you take some action. So that's important for people to know. And I'll maybe speak to it more soon, but I'm just going to go ahead and say, talking about statutes. Separately, but kind of similarly, the IRS has a 3-year statute for assessing additional tax, and the mechanism for them to do that is generally an audit of your tax return. And I want to point out that if you were to amend a tax return, that does not extend the IRS's statute of limitations for auditing your tax return. So they have 3 years to assess additional tax. And even if you were to say file an amended return 1 year before that statute expires, the IRS, if they choose to, you know, make changes to what you file, have to do that within that 1 year. They don't get 3 more years. So that's important to remember when you're kind of weighing the risks and rewards. When you think, oh shoot, could I maybe get audited if I do this? Maybe, but they do have a timeline that they're allowed to do that to you. So keep that in mind. Okay, so what is reasonable basis? Justin talked about reasonable basis earlier. Tax positions exist on a spectrum. And so you can have, and the spectrum is based on like the likelihood that your tax position would prevail in like a court case, if it were challenged, basically. So you have a frivolous position, which is like very low, like less than 20% likelihood, and basically you can't support it. And then there's a reasonable basis, a position with a reasonable basis, and that's the one we're gonna focus on because that is the minimum threshold required to take a tax position and protect yourself as a taxpayer from penalties for, you know, taking a frivolous position, basically. So you have to meet that reasonable basis standard. And to meet that, you have to have a position that's supported by one or more recognized authorities, which can be the tax code, court cases, IRS regulation, etc. What's interesting about a reasonable basis standard is even though it's meant to be like an objective standard, it's kind of applied subjectively because the IRS might say you don't have a reasonable basis for your position, but then we say we do. There's, you know, here's the long history of you know, why we believe cannabis doesn't fit within the meaning of a Schedule 1 or 2 substance. Here, you know, here's all of this, and then here's an active court case that's arguing this position, and here's the language of the tax code. And then the IRS might just say, well, it's listed as Schedule 1, and therefore you don't have a reasonable basis. But the thing is, again, you have a chance as a taxpayer to challenge the IRS's position. So that's important to remember. There was a news blast or something, a newsletter that I don't remember what it's called, that the IRS issued last year or 2 years ago now, I can't remember, that basically tried to claim that. They said, you know, some people are filing amended returns under, and they were just like kind of blanket language. There's a variety of positions people are taking. These positions don't have a reasonable basis, and they noted that filing an 8275, which is a disclosure form you can include with your tax return, does not protect you if you don't have a reasonable basis. That's the IRS's position, but it's kind of, when you kind of see this long history, and if you were to read the briefs in New Mexico Top Organics and the friends of the court that have spoken up about this, it really seems really hard to imagine that they would win if you were to challenge that they said, no reasonable basis.
I like calling it a strongly written email.
Yeah, the news blast is kind of like a strongly written email. And it does deter, to Justin's point, it does deter much of the industry from moving forward, but that doesn't necessarily mean that the IRS is prepared to defend that position. And so that's what I think we want taxpayers to be aware of. So if you have a reasonable basis, which as noted, we believe there is a reasonable basis for these positions because of the statutory language of the tax code, because of the current tax court case, and all of these various other things we've discussed today, then you can take a position. And even if that position fails to be successful, so this is important, the IRS can still deny it. They can say, you know what, we disagree and we're not gonna allow your amended return, for example. You're protected from penalties, and I think that's what's really important. So that's when we talk about risks. Penalties are a risk, but if you can support your reasonable basis position, you shouldn't be penalized. You should essentially be where you were if you didn't act at all, right? So you gave it a shot, you could be successful, or you could just kind of be right back where you were before. And I just want to do a quick plug for the disclosure. Transparent disclosures are extremely important. You need a disclosure to support your reasonable basis position. And so make sure you're filing those with your tax returns if you're planning on doing something like this. Okay, so let's talk about the risks again. So as I mentioned, the IRS can deny the claim. They could initiate an audit if the statute of limitations allows them to do so. We have heard of some erroneous refund claim penalties being assessed, and that's something which is kind of interesting. We haven't seen them personally, so I can't speak a lot to it. And I would, if I had to speculate, it is speculation, I would imagine those might go along with a refund claim that didn't have a sufficient disclosure with it. Because that disclosure, as I said, is key to defending your position, explaining what you're doing, explaining that you're not just taking a frivolous position, but that you've thought about it and you're not applying 280E, intentionally. And so if erroneous refund claims are important to know that they exist, those penalties, because they are substantial. You won't even have gotten your refund, for example, and they can still say, like, I think it's 20% of the claim that you requested, right? So that's tough. If you do, let's say they do issue you a refund. So they process your return, they issue you a refund. The IRS does have the ability to attempt to claw back that refund within 2 years. They can say it was erroneous and therefore we want to take it back. If you don't just willingly give it back to them, if you say, no, I think I deserve that refund, then they have to sue to get that back from you. And so there is, I do think it's important we mention, there is one MSO that's currently dealing with that. It's the only one we've heard of so far, at least to my knowledge, that's been dealing with a clawback attempt. And that's TerraSend. And so in May, the IRS did sue to try to get, I guess it's the DOJ, IRS, I don't know exactly how it's classified, to try to get that erroneous refund claim back. But one thing that's really interesting to me about that clawback attempt is that not only are they saying, oh, because of 280E, you shouldn't have gotten that refund, but also when there are refunds greater than $5 million on a single return, those claims are supposed to go through a second level of review before they're issued. It's called the Joint Tax Committee. And for whatever reason, it failed to go through that review before the refund was issued. So I think that's kind of interesting. It's like they're choosing the one that had like an administrative error on top of the 280E thing. So I don't know, we don't know how that's going to play out either, but that is a possibility. If they do try to claw back your refund, you will have interest that has accrued for the time that you've held on to those funds. So that's a risk. And one thing I want to also note, I know we're running out of time here, so I'm kind of rattling, but you can choose to fight as much or as little of this process as a taxpayer as you want. So let's say you're like, okay, I want to go ahead and attempt an amended return, and then the IRS denies the return. And you can just leave it at that. And you can say, okay, they denied it. I'm just going to be okay with that, and I'm not going to fight anymore. Or you can choose to appeal that decision, and you can ultimately choose to even sue for that refund if they deny it. You have kind of like, they have 2 years to claw back your refund. You have 2 years to sue them to try to get that refund. But you can also go through a less intensive appeals, like administrative appeals process in the meantime. And at any point, you can just throw your hands up and say, I don't want to fight this any longer, and you can just agree. So it's not like a death sentence. If the IRS denies it, you can just say that's okay. And same with these refund claims. Let's say you got a refund and then they try to claw it back. You can just give it back to them, and then they're not going to sue you. They can say I want it back, and you can say, okay, here is it back, and here's your interest. And that's really was the risk, was that interest. So our actual experience, important to touch on that. We filed a lot of these claims, refund claims, and amended returns at this point. I think over 100 returns, and we have seen they take a long time to process. Super important to note. It can take up to 13 months. We've seen even longer than that for these returns to actually get processed. So you're going to have to, file the return and then wait. Of the ones that have been processed, we have had a majority of them be successful. So I think we're in the high 70% of success, meaning a refund was issued or an outstanding tax liability was reduced. Some of them have been denied, and that has just been it. So they've been denied. We have seen no audits thus far, and we've seen no penalties thus far. And we have begun the process of appealing those denials for a number of our clients, and we're going to kind of see how that plays out. So we're waiting for that to play out. Justin, I'm going to do you have anything you want to say? I ran out of time.
Yeah, I wanted to be clear that, rescheduling has made it so that 280 doesn't apply to medical for 2026. We're waiting. The Attorney General asked the Secretary of Treasury to consider amendments for medical. I think the New Mexico Top Organics case has a really strong case now that they may win, but what about adult use? I think it's important to note that the way that, to ask the question, how are they being able to take a flower that was produced by like a medical and adult use license, like that could be purchased by either a person with a medical card or a person who doesn't have a medical card, but it's the same product. How can they say that one is medical versus one is not? And argue that fits the criteria of those. And so we're saying this is open for everybody, not just medical people. Mm-hmm. Like amending, moving forward without proactively paying tax on 280E or phantom income is it's allowed. We're not saying do it, but you should consider it. Mm-hmm. Then the other thing is like opinions. A lot of people are like, do I need an opinion? From an attorney. If you're over like a couple $1 million in refunds, that's what you're looking for. Definitely opinion would be good because you got to go through that extra layer of review. But we use a disclosure, an official disclosure that was written by an attorney, and it's pretty sophisticated, and it is more than adequate for what you need to do those. And then there was a couple other things, but I'll turn it back over to you for final thoughts.
Yeah, I think the main point, you kind of touched on it, is just that this is kind of an ongoing conversation. And I think it's important that people aren't so scared of the IRS. So you can take these positions and challenge them, and it can still be kind of a cordial conversation, right? So they might send you a notice, you might reply and say, hey, I disagree with that. And there's a conversation that happens. It's not immediately, really scary outcomes. And so I think people can engage in the conversation, and the more people do engage in the conversation, the more we might kind of move the needle, right, for the industry. And so just encourage people. Everybody's risk tolerance is different, and so we understand that. So only you as the taxpayer, if you're here taxpayers, can make the decision for yourself. But my goal is that people feel informed and kind of empowered to make a decision that's right for them.
Nice.
Okay, I think we sort of ran out of time. I don't know if Chris wants to take it for Q&A.
I don't think that, I'm looking at Q&A, I don't see a lot of questions, which is pretty interesting. And we're at the hour. I mean, there's much more to talk about. We'll do a follow-up Q&A. We'll email everybody, invite them to another webinar where we could just answer questions. A lot of people want to know what the realities of it is. And remember that, I wanted to add that the IRS's methodology is deterrence, right? So like, even with that Treasury regulation that tried to squish 471C, they never took that to tax court. They never challenged it, but they wanted to put a wet blanket on it, right? They want to keep people from using it. It's the same kind of thing with that strongly written email saying, hey, you can't do this. And it's like, well, you can say that, but it doesn't necessarily mean we can't. So it's things like that. All right, let's see. Well, we got a couple. Disclosure of reference, is it available? We can maybe talk more about that at the webinar, like the follow-up webinar. Awesome.
Okay, well, thank you, everybody. Really appreciate it.
Terrific. Yeah. Thank you, Jamie and Justin. Yeah. We want to thank you both for a great session as always. Thanks to the attendees for taking the time. We're going to have this session ready for on-demand viewing very shortly. You'll find an email in your inbox when it's ready for that. And in the meantime, thanks again to everyone. Take care. Have a great rest of your Monday and an excellent week.
All right. Thanks, everybody.